Subscribe to my channel Report Stock.
Welcome to the deep dive. We're all about getting you properly informed fast. You know that feeling, right? When a company's about to report earnings and you feel like you're just scratching the
Yeah,
surface.
just seen the headlines.
Exactly. It's way more than one number. You want to get into the operations, the strategy, the real why. But honestly, who's got the time to sift through all those dense reports?
It's a lot.
That's where we come in. Today, we're diving deep into Goldfields Limited, GFI. Big player in gold mining.
Absolutely. Major global name.
We're going to pull apart their Q2 and first half fiscal 2025 outlook, get a real handle on the investment thinking around them right now. So, our mission for you is simple. Unpack the key financials, the production stuff, strategic moves, where they sit in the market. We're pulling the core bits from our source material and investment thesis, some related analysis so you get the picture quick and clear.
And the timing is good, too.
Perfect timing, actually.
Yeah.
GFI reports those results on August 22nd. So, yeah, there's definitely a bit of anticipation building.
There certainly is. An earnings report for a company like Goldfields, it's never just one thing. It's where you see how all these operational bits and market forces are actually playing out.
Totally. Okay, let's get into it then. GFI reports August 22nd, Q2 and H1 25. What's the street saying? What's the sort of baseline expectation for Q2 earnings?
Right. So the Zacks consensus estimate for Q2 2025 earnings is sitting at 59 cents per share.
Okay.
And what's kind of interesting is that number hasn't budged for 30 days. Stayed completely flat.
30 days unchanged. What does that usually signal?
Well, for an investor, it often means analysts aren't seeing, major new stuff, positive or negative, that's making them rush to change their short-term forecasts. It's stable, maybe, but not exactly buzzing with new inputs.
Right, a stable baseline, 59 cents. But, stability doesn't always mean predictability. Does a model like Zacks, which tries to find an edge, just to suggest anything different, maybe a surprise beat?
Well, that's a key point. Our proven model, in this specific case, doesn't conclusively predict an earnings beat for Goldfields this time around.
Oh, interesting. Why not?
Okay, so for the model to signal a likely beat, you generally need two things. First, a positive earnings ESP that basically shows that the most accurate analysts are tweaking estimates upwards right before the report compared to the general consensus.
Got it.
And second, you need a strong Zacks rank, like a #1 strong buy, a #2 buy, or maybe a #3 hold.
And GFI?
GFI does have a Zacks rank of 2, a buy, so that's good.
Okay.
But its earnings ESP is 0.00%. Zero.
So no last-minute positive nudges from those top analysts.
Exactly. So even with the good rank, the model isn't getting that extra signal suggesting a surprise driven by analyst sentiment shifts. For you listening, it means we really need to focus on what actually happened operationally in Q2. That's where the story is.
That makes perfect sense. If the models aren't screaming beat, then what happened on the ground in the mines, that's what really matters. That's often where you find the real insights, isn't it?
Absolutely. That's the core of it.
So let's shift gears. Forget the predictions for a moment. Let's dig into that operational performance. What shaped GFI's second quarter?
Right. So production-wise, they had a really strong first half of 2025. Total production hit 1,136,000 ounces.
Wow.
Yeah, that's up a hefty 24% compared to the same time last year.
24%. Oh.
And for Q2 specifically, it was 585,000 ounces, still a solid 6% increase year over year.
What's driving that?
A big piece is the Salares Norte project in Chile. It's ramping up nicely. The processing plant ran well even through the winter down there, and it chipped in 73,000 gold equivalent ounces in Q2. That ramp up is key.
Okay, positive progress there.
But, and this is an important nuance, it wasn't strong everywhere. Tarkwa, their mine in Ghana, its gold production was actually lower in the quarter.
Lower. Was there a problem?
Not really a problem, more like a strategic choice. They decided to prioritize waste stripping at Tarkwa.
Meaning moving more rock that isn't ore.
Exactly, to get to the better stuff later. So while they did that, they supplemented the feed to the plant with some lower grade stockpiles they already had. It temporarily lowers output, but sets them up for better mining down the road. So, a long-term play.
Okay. So sacrificing a bit of Q2 production at Tarkwa for future gains, that makes sense in mining. Classic move. But even with overall good production and that smart thinking at Tarkwa, mining costs money. It always does. Are things getting more expensive for Goldfields? What's the cost picture look like?
You're right to ask. Costs are definitely up. The all-in cost, AIC, they're projected at $2,054 per ounce for Q2. That's higher than the $2,861 they saw in Q2 2024.
Okay, quite a jump.
And similarly, the all-in sustaining cost, AISC, that's expected around $739 per ounce. That's a 7% increase from last year.
So why the increase? Is it just GFI or something broader?
Well, the sources point to two main things. General mining inflation, fuel, labor, supplies, everything's more expensive across the board for the industry.
Right, we hear that everywhere.
And the other factor is just higher volumes mined. They're doing more work, moving more material. So yes, costs are up, but it's linked to that increased activity and the wider inflationary pressures, not necessarily, say, a drop in efficiency. It's the cost of doing more business right now.
Got it. So context matters. Production's generally up, but costs are also up because of inflation and doing more work. How does that all shake out on the bottom line? What are the earnings actually looking like based on our sources?
Well, this is where it gets pretty impressive. The earnings projections are looking remarkably strong. It suggests that the higher production volumes and, crucially, the better gold prices this year are really winning out over those rising costs.
Okay, so what are the numbers?
Headline earnings per share for the first half of 2025 are expected to land somewhere between $1.09 and $1.21.
Wow, compared to last year.
Yeah, that's a huge jump, like 203% to 236% higher than the 36 cents per share they reported in H1 2024.
That's not a massive increase.
It really is. And if you look at normalized earnings per share, the outlook is $1.06 to $1.18. That's still up 165% to 195% compared to the 40 cents in H1 last year.
So what's the simple story there? More gold sold at higher prices.
That's basically it. Higher gold volume sold, plus that tailwind from the upward trend in gold prices we've seen. Yes, the increased cost of sales took a bite out of it, like we discussed, but the top-line growth from volume and price was just much more powerful. Really carried the day for the bottom-line forecast.
Incredible numbers. Sounds like they're managing the cost pressures pretty well, all things considered. Given that kind of performance, how does Goldfields actually stack up against its peers in the market? Is it standing out?
Oh, it's definitely standing out. Performance-wise, GFI shares have gained, get this, 122% year-to-date.
122%.
Yep, and that absolutely dwarfs the broader gold mining industry's average growth, which is about 72% over the same period.
That's a massive difference. Can you give us some specific comparisons?
Sure. So GFI at 122%. Compare that to, say, Franco-Nevada, FNV, that's up 47.5%, or Agnico Eagle Mines, AEM, up 66.5%. GFI's performance is really in a different league this year.
Clearly. But sometimes you see that kind of run-up and you wonder if the valuation has gotten ahead of itself, right? What do the numbers tell us there? Is it expensive now?
Well, this is where it gets really interesting, actually, especially if you're looking at it as a potential investment. GFI is currently trading at a forward price-to-sales ratio of 3.11.
Okay, 3.11. How does that compare?
It's actually favorable compared to the industry average, which is sitting around 3.4.
So below the industry average, even after that huge run.
Exactly. And the contrast is even starker when you look at those peers we just mentioned. Franco-Nevada trades at a forward PS of, wait for it, 19.54.
Whoa, okay.
And Agnico Eagle Mines is at 6.07.
Right. So GFI at 3.11 looks quite reasonable in comparison.
It really does. That's a key insight, I think. Despite the stellar share price performance, the valuation, at least on this metric, hasn't ballooned in the same way as some major competitors. It suggests there might still be, relative value there. Maybe the market hasn't fully priced in that growth compared to others.
That's fascinating. Strong performance, but maybe not overvalued yet. Okay, so we've got strong Q2 performance shaping up, amazing earnings growth, standout market gains, and this potentially attractive valuation. Let's look ahead now. What does this all mean for Goldfield's strategy, their future? Are they set up to keep this momentum going?
It certainly looks like they're positioned for it. They're sticking to their full-year gold production guidance, which is 2.25 to 2.45 million ounces.
And how does that compare to last year?
Well, that guidance itself points to about 13.5% year-over-year growth.
Yeah.
So it's not just holding steady, it's projecting continued solid expansion for the full year.
13.5% growth target, that's strong. How are they planning to hit that and keep growing beyond this year? Any specific strategic moves, acquisitions, projects coming online?
Yes, they're very focused on strategic growth, specifically targeting high-quality, long-life assets. That seems to be the mantra.
Makes sense. Examples?
Okay, prime example.
Yeah.
The Windfall project up in Quebec. They got full ownership of that by acquiring Osisko Mining in 2024. They're pushing that project forward, and the target there is a pretty hefty 300,000 ounces of gold production annually.
300,000 ounces from one new project. Okay.
Then there's Salares Norte in Chile, which we mentioned. The ramp-up continues, and they're expecting commercial production, like full declared production, in the third quarter of this year, Q3 2025. That's a huge milestone coming up very soon. It'll be a significant contributor.
Right. Solaris Norte hitting commercial production in Q3. What else?
Another really interesting strategic move is the proposed acquisition of Gold Road Resources. This would give GFI full ownership of the Gruyere mine in Western Australia.
Don't they already operate that mine?
They do. GFI is the operator currently. But full ownership would give them much more flexibility, in how they run things day to day and how they plan future developments or expansions there. It simplifies things and should boost its cash flow contribution directly to GFI.
So consolidating control over a key asset they already know well.
Exactly. It fits that strategy of consolidating high-potential, long-life assets to really build long-term value and cash flow.
That paints a very clear picture of their growth pipeline. So let's tie it all together. We've got the strong Q2 likely coming in, the huge earnings jump, the market outperformance, the attractive valuation, and these clear strategic growth projects. What's the final takeaway? What's the core investment thesis here for someone looking at Goldfields right now?
Well, I think the core thesis is pretty compelling. Goldfields looks very well positioned for strong Q2 and H1 results, mostly thanks to more production and those helpful gold prices.
Right.
Yes, costs are up. That's a factor. But their operational strength seems to be more than compensating. And looking beyond just these results, they've got a really solid defined growth pipeline. You've got Windfall, Solaris Norte coming fully online soon, the Gruyere consolidation. These aren't just small tweaks. They're significantly enhancing their production base and their future cash flow profile.
So strong now and building for the future.
Pretty much.
Yeah.
And when you combine that with the valuation, which, as we saw, looks quite attractive compared to some big peers, and these strong long-term fundamentals, well, the overall picture presented is that GFI is a solid stock to consider owning within the gold space.
That was a fantastic deep dive. We really unpacked a lot there on Goldfields. We looked at the earnings setup, the operational details driving Q2, like that strategic move at Tarkwa, the really eye-popping earnings surge, how they're crushing it in the market compared to peers, and that interesting valuation angle. Plus, we got a clear view of how moves like getting full control of Windfall and Gruyere are meant to fuel their future. Hopefully, these key takeaways give you a much sharper picture than just the headline.
Absolutely. It really highlights that constant dance, doesn't it, between operational execution, smart strategic planning, and what the broader market and economy are doing. It all shapes a company like Goldfields. It's never simple.
Never simple. And that leads to a final thought for you to chew on as we wrap up. We've seen Goldfields executing its strategy, right? But think about those bigger forces out there. How might things like global economic wobbles or stubborn inflation, or what central banks decide to do with interest rates? How could those influence gold prices down the line?
Yeah, the macro picture.
Exactly. And how would that, in turn, affect GFI's profitability beyond these next couple of quarters? How do those huge macro trends potentially intersect with GFI's specific mine plans and acquisitions? What stands out to you when you think about those big forces meeting their detailed strategy? Something to mull over.
Definitely food for thought.
That's all for this deep dive. Thanks so much for joining us. We hope you feel more informed and ready for those upcoming results. Until next time.
Subscribe to my channel Report Stock.